As our top story indicated, a rate cut is on the way, moving the spotlight onto Australian banks for their reaction. We're now in the lead up to bank half-year results, which are expected to reveal strong overall bank earnings, but falling profits on bank loans, their net interest margins, which, as we know, makes them very upset. Well, I'm joined in the studio now by leading banking analyst from CLSA Asia Pacific Markets, Brian Johnson. Brian, welcome to the programme.
Hi.
So rate cuts on the cards, obviously. How would you expect the big banks to respond next week?
Well, there's no way they're going to pass on the full rate cut to borrowers.
None of them?
None of them. And the reason is that increasingly their cost of funds is moving at a different rate to the official cash rate. And so what it means is that I think increasingly the Reserve Bank will be targeting the housing rate the banks actually offer, which means you're probably going to see rate cuts on the agenda for quite a while to come. You're
actually overweight in the banking sector, aren't you? I mean, is this one of the reasons that banks indeed will be passing on rising costs to the consumer?
That's correct. Tiki, if you really look dispassionately over the long term, we really haven't had much competition since the very early 1990s in Australian banking. And basically what happened was that you had Aussie home loans came in, the banks responded by cutting margins. Once we reached the equilibrium point, there's been no such thing as competition. But what has really happened is that in 2008, when the non-banks couldn't compete because the funding environment was even worse for them, the banks don't face a lot of competition, so they're really determining where their pricing goes. And that's why I'm positive.
Indeed. We thought, though, wholesale funding costs for a moment they were going to get better. In February, we had the ECB in Europe doing their refinancing, the LTRO, but everything seems to have gone pear-shaped again.
Tiki, there's a lot of ways you can explain it, but I think the best way is to think of a drug addict that needs a drug every 4 hours, and all the ECB do is they're giving you a drug for about an hour. You know, sovereigns in Europe need to borrow money for 10 years. Giving them money for 3 years helps out in the short term, but it doesn't resolve the fundamental problem that there's just way too much debt in these economies, and there's no prospect of them paying back in the very short term.
All right, well, we've had ANZ, of course, take a rather different road with their out-of-cycle moves and their different deliberation and setting times. What do you make of that strategy? Because even some this week on our programme in Small Business had thought it was a very, very bad PR strategy.
Well, I think it was predicated on the fact they thought the other banks would actually follow very quickly. In the new world, you can't signal what you're going to do on pricing. And increasingly, the cash rate, the Reserve Bank cash rate, is not what drives your cost of funds. So what ANZ have committed to do is every month they'll update on the second calendar Friday of every month. They'll update us on what's happening on their cost of funds and tell us what they're going to do with their rate from the next Friday.
Glad you've got the date right, by the way.
Yeah, well, it's a skill.
All right. What about this old property bubble that we occasionally hear about? Bad news recently, of course, the Bank of Queensland first half results, and then mortgage insurer Genworth delaying its IPO and now looking at a possible downgrade. Is this a problem, a likely problem for the big banks?
Massive problem. But you can have one of two scenarios. I mean, the first question is there a bubble? And you've only got to have a look at levels of leverage in households to see that clearly house prices are pretty hard to justify. But we can have one of two scenarios. We could have the dramatic collapse you've seen in the United States or the slow, gradual grind down we've seen in Japan. And the way Australian home loans are structured, they're probably safer than the ones in the US. So
but you're actually more worried about asset quality than you are about bank funding, aren't you?
Yes. It's you know, margins get all the commentary. But, you know, at the end of the day, if a bank chops 2,000 staff, it increases their earnings by about 1.8%. If the margin moves 5 basis points, which is not much, the earnings move 3%. But if their loan loss charge moves by 1.3 basis points, which is nothing, their earnings move by 1%. That is the really big sensitive issue for bank earnings.
Banks are also facing regulations, the new Basel III regulations. When I spoke to you last, I think you were quite worried about them. Has anything changed?
Yeah, I was 100% wrong. When you have a look at the way that Basel is working for the Australian banks, I would observe that I think it's very bank-friendly.
Bank-friendly?
Bank-friendly.
In what way?
Well, the way that they're allowed to treat dividends, the dividends they pay out means that it really doesn't come out of their capital base straight away. And also they're delaying some of the more onerous capital aspects of it till 2016, by which time the banks will be quite well capitalised. But the really important thing, Tiki, is banks don't go bust because they run out of capital. They go bust because they run out of cash. And when you have a look at the way that the Reserve Bank is the kind of liquidity facility they'll operate for the banks, they're not going to run out of cash anytime soon. So when I have a look at it, I just think it's very bank-friendly.
So what does this actually mean for the all-important bank dividends? Are they sustainable now, in your view?
Yes. There's no doubt about it that, we're in a low asset growth world where banks have to retain less capital. I think their earnings, because they've got the pricing power to pass on the margin pressure, are probably relatively safe. So when I have a look at it, the high payout ratios, yes, I think they are sustainable. And the most important thing is that if you look at big global fund flows, tonight we're hearing about Europe once again blowing up. 2 weeks' time you'll hear about it roaring back. A week later you'll hear about it falling over. The one safe thing that investors are looking for globally is dividends, and the Australian banks look very good in a global context on that basis.
So finally, taking the big four, which do you see best value and less value from an investor's point of view at the moment? Because they've got very different strategies about moving offshore and all this sort of stuff.
It's hard to kind of call them from time to time, but for me it's pretty black and white at the moment. When I have a look at it, National Australia Bank has managed to deliver a very round number of EPS growth basically in the 10 years up until 2010, and that EPS growth figure was 0. The end fact is that the market treats NAB as though it will fail in perpetuity. I think that actually makes it really, really cheap. So NAB is a risky bank, but I think it's way too cheap. And so that's why we've got it as our number 1 pick. Our number 2 pick at the moment is Commonwealth Bank, which everyone always tells me is expensive. But if you sold Commonwealth Bank every time over the last 15 years when it was expensive, you would have lost a lot of money. ANZ has had a big run. I still like it. And I think Westpac have got a lot of structural earnings growth issues at the moment, so I've got a negative view on them.
Brian Johnson, you got it all in. Thanks so much for joining us.
Thank you.